my money's earning 5 and I'm paying 5, what do most of you think you're making? Most of you think you're making 0. But this whole argument on IBC group is you're actually making more here because this money's compounding. This is simple interest. So every year, instead of 10,000 one year, next year you got 10,000 or 105,000. And the next year you got more and more and more because of compounding. So you're always going to beat simple interest with compound interest. Welcome back, everybody, to another week of the Wealth Webinar. And today we're talking about money. We're talking about your money for today because everything's going to start falling apart. You just had inflation spike at 9.1%. The Fed's doing its very best to curb the inflation monster. And it just hit this morning, fresh off the press, 9.1%. The Fed's going to meet or come and say what they're going to do to interest rates in a few short days, right before our live event, July 30th and the 31st. You're going to find out what the Fed's going to do, which is going to really set the stage for the duration of 2022. And my guess, they're going to keep increasing rates more and more at really crazy amounts, because if they can't tame inflation, they are bound and determined to destroy the stock market. And along with the stock market, the economy, and along with the economy, some real estate markets. So are you ready for that? Well, today, we are going to get you ready, that's for sure, because many years ago, and Stephen remembers this, with me sitting, at a bar with him. I think we were in LA. We were sitting at a bar, and I remember telling him, I said, it's never about your actual resources. It's about how resourceful you can get. And, I was looking through the book today. I haven't read this book in a while, but right here in chapter 1, I said that exact same thing. It's never about your actual resources. It's about how resourceful you can get. A lot of people want to enter real estate, but they don't because they're so caught up in worrying about the money. They're always worried about, how am I going to do real estate if I don't have enough money? One of my favorite excuses back in the day is, when this or that happens, I'll invest in real estate. I put off buying real estate way too long. And that's all in this book. And that's some of the stuff we're going to talk about today is really going to be all about that. There it goes. It's right in Stephen's presentation.
I love it. It's my favorite quote from you. Absolutely.
He took it pretty serious. Now, it's not an original quote. I don't know where I got it, but I've been using it for a long time. The biggest thing I think we need to all realize is times are a-changing. If you ever heard the Bob Dylan song, times are a-changing, and they're changing fast. So we have to change fast. We have to adapt fast. We have to pivot fast. Now, I'm not going to tell you how to pivot fast with a lot of things in your life, like your diet and all that stuff. Call somebody else for that. But we're going to talk to you about how to pivot fast with your money. Because if you haven't looked at your statement lately, and what statement am I talking about? Your 401k, your IRAs, your 457, TSP, whatever you got going on there, your brokerage account with your trusted advisor. Have you looked at that lately? Anyone want to share how that looked? Are you down 20? Are you down 30? I mean, anyone that's heavy in tech, the famous FANG stocks, your portfolio is hurting right now. And the problem with that is it's going to hurt even more. It's probably going to go down even more. So we need to make some decisions. And I'm super glad that many years ago, one of my mentors, you've heard my story, when I was at one of the lowest points, a guy got up on stage by the name of Greg Hurleen, and he said the ultimate in real estate is being the bank. I had no idea what he was talking about. We clearly do today, but back then I had no idea. To be the bank to me back then meant, I got to have millions of dollars. This guy's got millions, and that's why he's the bank. So I just got to get millions of dollars. And my path to wealth was flip my way there, because I wanted a TV show, which is what led to Risky Builders. So flip my way to wealth. And then when I got to that point, eventually I would take Greg's advice, which he gave me back when I had next to nothing. I had just lost it all for the second time in 2014. He said, the ultimate in real estate is being the bank. But in my mind, I hadn't yet articulated it's not about your actual resources. You notice I was associating, I need to have $1 million. I got to have the resources to make this happen. But that wasn't the case. You see, a lot of people think, Oh, I've only got 25 grand. There's no way I could become a private lender. I couldn't go on Private Money Club and lend with only 25 grand, or I only got 50, or my IRA's only got 75. Whatever your dollar is, doesn't matter. You can still be a private lender because you can pool your money together with other private lenders and take down large deals. I don't know how many of you follow privatemoneyclub.com, which it's still in beta, so it's never been advertised. So if you haven't heard about it, makes sense. We don't advertise it. The only time you hear about Private Money Club is in trainings like this. We bring it up, we mention it. But I will tell you something, you're gonna know about it. The whole world's gonna know about it, starting with the United States of America. We gotta start small. You know, US is big enough for us right now, because October 14th, we're launching Private Money Club to the world. And this is a once in a lifetime kind of thing. Maybe for some of you, you're like, maybe it's a once in a decade thing. But this event, this launch is going to change the way money's used forever. It's going to change the way that people get money for real estate. And in the future, probably the way that they get money for cars, and the way that they fund their businesses, and the way that they buy jets. Because right now, what is the traditional path that we do everything? Let's do a quick recap. Stephen knows this well. We all know the path we've been taught from a young age till now is we hustle and work for money. We trade hours for dollars for this. When we make this money, we do what? We put it into the bank. What does the bank do? The bank then turns around and makes that money work for them by loaning it out. And in doing that, they make a spread. We all have seen that enough times. If you haven't and you're brand new, actually, let me get a shout out for all the over 100 people on here. How many of you are brand new to Wealth Webinar? How many of you are, this is your first time here? Put I in the chat. And if you are putting I, welcome. That's all I want to say from Stephen and I. We appreciate you being here, and we are not going to disappoint today. But that's what you've been taught to do. You've been taught to do what your parents did, what your grandparents did, and what many generations have done. Give up control of your money to the bank. And then when you need money, what do? You need money to buy your primary residence. You need money to buy that duplex. You need money to buy that car. What do you do right now? You go back to the bank where you deposited the money, because that's where your relationship is, right? And you borrow money. And how much do they charge you on the loan? It doesn't matter. We don't need to get specifically, into the percentages, but the answer is more than what you're earning. You gave them control of the money that you worked for, and for that, they probably paid you an interest rate. Many of you are earning nothing and you're saving and checking, but let's just pretend that they're paying you 1. And then what do? They lend it out for more than 1. And in doing that, they make a spread. Banking 101, folks. This is how banks make billions and trillions of dollars off of your hard work, off of being in control of the money you gave up control of. This is what we've been taught to do. And today you got to draw a line. Today marks the day where you got to start changing who's in control of your money. Because if you don't, and you put all your trust in institutions, you put all your trust in Wall Street, you put all your trust in your fancy dancy 401k, it's going to be a massive mistake. Matter of fact, I'd already argue that it is a mistake, because we all saw the cracks in the system in 2008 when we almost lost the entire financial system. It almost kaput. It was almost done. But they printed $900 billion and they saved it by bailing out banks. They didn't bail them all out, though. Some of them went kaput. Just like today, some of those bankrupt crypto hedge funds are gone, and the people that had money with them, well, I'm sure that'll be caught up in a lawsuit for years to come, but they might get some back. You got to start really, really understanding that the only one you should be trusting and the only one that you should be putting in control of your money is you. And I know that's difficult because you're like, oh, I don't know. Show me the way. Well, here's the deal. I'm going to show you one way today. Actually, we're going to show you 2. We're going to show you how to be the bank by lending out money just like a bank does. Do you know who else lends money? Lending is a massive business. It's been around for a long, long time. When you look over here, why BYOB private lending? Because that's what we're going to call it. We're going to call it BYOB. But why private lending? Well, it's secured and collateralized. When you go to the bank and you get a loan to buy a piece of property, what's the first thing that they're going to do? They're going to collateralize the loan with the property you're buying. The car, how about that? Yes, they're going to put a lien on your title. You've all done this. Your boat, yes, they put a lien on the boat. The jet, yes, they put a lien on the jet. I'm just going up the hierarchy. Almost everything you borrow money for is collateralized, cross-collateralized, securitized, or personally guaranteed. Most all of those are personally guaranteed and collateralized. Why go for one when you can have both, right? If you're not first, you're last. And they're like, well, you're going to be first, but let's actually have you sign on the dotted line so that everything else you own is also behind this thing besides the collateral. So that's a great thing. I love that. Now, let's just compare that to the stock market. Are you collateralized? Nope. Secured? Nope. Maybe some bonds, but you're secured by the company. How about that crypto? Any security or collateral there? Oh, no. Stable coins are though, right? Oh crap, we just saw something happen with those, didn't we? Those kind of just showed a little bit of a crack. Those guaranteed stable coins that they were doing, some of them are having some issues right now. So I always lead back to, well, let's just do what they've done for hundreds of years. Let's read a little bit about the Great Depression and what was the number one thing that people pivoted to during the Great Depression or after the Great Depression had already begun. They lost faith in Wall Street, and you are soon going to lose faith in Wall Street. If you still have faith in Wall Street, good for you. You're going to lose it pretty soon. And when you lose faith in Wall Street, you're going to look for an alternative, just like they did back in 1930, 1931, 32, and so on and so forth. And what did they start doing? Well, banks were seized up. Money wasn't easy like it has been the last decade or more. Money was tough. Banks weren't lending. So what did people start doing with the money they had? Started lending to one another. This person needed money to start a business. Well, this group of people, individuals, would then lend to them. This person needed money for, well, I don't know, let's call it a car because cars are around. So they'd go to this person and this person would lend money and the car take collateral. House, real estate, land, all this stuff. Look it up. That's exactly what happened. People lost faith in the traditional financial systems, Wall Street and banking, and they took it upon themselves to then become the bank. This isn't new, folks. It's been around forever. Read the book, The Richest Man in Babylon. This is all they did back then. The richest man in Babylon, you know what he was? You know how he was the richest man? Well, number one, he followed the laws of gold, which I've now kind of created the 6 laws of wealth, basically off the principles of the laws of gold. But you know what he did? Lent money. He was a private lender. And he always said his money was always out working for him. Just like the bank has your money out working for them. Well, that's what he did. So that's before Christ, folks. How much more track history, how much more proven history do you need to say that this is probably a good thing to start looking into? But again, we always say you should invest in things you know, like, and understand. So you're going to have to get to the point where you actually know it, which we're going to do a good job today of teaching it. You have to like it. You might not like being a lender, and then we're going to have to look for a different alternative for you. So you have to know, like, and understand it. And that's what we're going to hopefully get through. So secured and collateralized. How about returns? I mean, why do you invest money? You know, I did a training on YouTube. It's not out yet, but it's coming out. That'll be the next one, all about what's easier, buying or selling. Me and Stephen talk about this all the time. What's easier, buying an investment or selling it? Well, buying is. And why do we buy an investment? To make money. But do we ever have an expectation, or do we ever have rules set in place for how much money we want to make? I know I do. I know Stephen does. But how many of you, when you buy an investment, I don't care if it's Tesla, Apple, a duplex, a triplex, a syndicate, do you have an anticipated return you want to make? Is it 10%, 20, 30, 40, 50? And then what happens when you get to your intended profit that you set? Your stock, and I'm just going to pick on Tesla because Elon's all over the news. So let's just pick on that. Let's say Tesla, you bought it and it hit 30% more than what you paid for it. And that was kind of your goal when you bought it. Did you sell it? No, most people don't, because they're like, oh, it's going to go to 40. And then what happens when it goes to 40? You're like, oh my God, I can't believe it made it to 40. Did you sell it? Nope. You were waiting for more. Then all of a sudden the moon, right? You were going to the moon. And then what happens to all the people that seek those unrealistic returns? The 4th law of wealth. Your money will flee you. And that's what's happening right now. So when you invest, you have to have a stated goal. But when you lend, number one, you're going to have a higher fixed return on your money. That's the easy part. And it's going to be a predictable return. I mean, do you think banks wonder how much they're going to make when they loan you money? No, they know. $259.64 every month. That's how much they're going to get. And then guess what? If you don't pay them, what do? Warning letters. If you don't pay them for long enough, what do? Take your shit. Your car disappears over the night. Your house gets a big foreclosure. They just take the stuff. Why? They're collateralized and secured. It's flexible. It's controllable. It's in your control when you're the bank. You see, when you become a private lender, you control everything. You control the terms you want. You control the return you want. You control the collateral that you demand. Heck, you might say, hey, I'm okay taking this property as collateral, but I also want you to cross-collateralize it. You're a newer investor, so I don't really have a ton of faith in you. So what I'd like you to do is not just collateralize it with this property. How about your other house you own? I'd like to cross-collateralize that as well. So now you're double collateralized. You're in control of that. You could do that. So it's flexible, controllable, and in your control. And we already hit this one, but it is historically a proven strategy. Longer than the stock market, longer than anything. This has always been the way things are done. Bartering, whatever you want to call it. So is this something you want to do is what you really have to ask. Most people would say that they don't want to do this, or they don't know if they want to do this. And the sole answer typically comes down to the fact that I don't know how, which really isn't the truth. Number one, I just gave you the book. This book shows you it's only 101 pages with fluff, pictures and everything, 101 pages. So that'll teach you how. And you're still like, oh, I'm just not sure. I've never done this before. Well, you never drove a car before 16 years old. Maybe you did, but you never really drove on the road until you got your learner's permit. But you figured that out. You never rode a bike before you actually got on the bike. You figured that out. There's many things in your life that you didn't know how to do that now you do just fine. It just took a little bit of time, a little bit of practice, and it took some consistent and persistent action. This is no different. And then the other thing too, when people say, oh, I don't know how to, actually you do, because you've been on the other side. You've been a borrower. Every one of you on here has probably borrowed money for a car, a boat, finance furniture. You've used credit cards. Maybe you've got a mortgage on your house. You've all used loans from traditional banks. So if you just stop for a second, you just think, what was the process that you went through with the bank? First, you met with them. You presented the opportunity for the bank, which is what you wanted to get funded. I'm buying this car. And then what did they do? They went on and they looked at the value, NADA, Kelley Blue Book, whatever, they looked at the value. They wanted to see what their collateral was worth and how much you wanted to borrow. Then what did they do? They made sure you're a good borrower. They started to kind of go into your personal finances, it's called a personal financial statement, to say, can this person afford this loan? Do they have enough income? Do they have enough household income? Are they the sole income person in the house, or do they have a spouse that's bringing income in? How many assets do they have? Have they ever defaulted? What's their credit look like? So on and so forth. They just very quick checklist. Boom, boom, boom. Yep. Okay. And then after that, what did you do? You filled out an application for it, which had all your personal information. And then after that, what did you do? You signed some paperwork giving the bank security, giving the bank collateral. You also signed some things personally guaranteeing the loan. You did all this already. You did it because you needed the money from the bank that you deposited your money in. Let's just reverse that. Let's say you are the bank. Just remember, what were the things the bank did? They're all right in the book, and we're going to cover them today. That's all you do. Maybe a little different for each kind of asset, but let's just stick to real estate for today, because Private Money Club is starting at launch with real estate. That's all we're doing. Okay. After that, it will evolve. It will build. Because, hey, you guys don't believe that? Well, Amazon, if you recall, back in the day, sold books. That's right. You wanted a book? You went to Amazon. Today, 2022, what do you go to Amazon for? Anything. You want a jet? Amazon will sell you a jet. You want an island? I don't know if they sell islands on Amazon yet, but that's coming. But they started with books. We're starting with real estate, folks. So let's dive into this. The audiobook is for sale. You can buy the audiobook, but I can't give you the audiobook for free. All right, Steven, so let's dive into this. What are some of the things we want to really start with? To be a private lender, what do you think the most fundamental basics are that somebody needs to get down?
Yeah, I mean, so when I talk to people, it's kind of a fear more than anything, and the fear comes from not understanding, not having done it before, like you were saying. And so you have to kind of understand the basics of what we're doing with private money lending, right? So first off, when we lend money to somebody, what happens, let's look at worst case scenario first, right? So what happens if that person just runs with my money or doesn't abide by the terms that we agreed upon? What happens there? So that's something that I hear a lot. What's like the worst case scenario? What could go wrong? Can I lose all my money? So I think we could maybe start with the basics of, what that looks like, how your money is actually protected, what we do to make sure that it's a good investment, and kind of go from there with it. Because when we lend somebody money, it's a legal contract that binds them to the terms of that contract. And if they don't fulfill on it, then we're protected. Our money is protected through that hard asset, through that property, through that real estate, or through, whatever that might be. So I think we could start there, really, Chris.
So I think that's definitely a really good place to start. So when we're talking about lending, you're always thinking the negative, and that's good. I mean, hopefully when you buy a mutual fund, an ETF, or a stock, you're thinking about what are the downsides? What are the potential risks with me buying this stock? And then you decide, okay, those risks, are they within the parameters of my risk return profile, which every one of you has? How much risk are you willing to take for how much return are you willing to get or wanting to get? If they match, boom, we got to win. So when you're looking at this, you have to really look at the risks. And what are the risks? Well, I put them up here. These are some things that you should be aware of. So let's just hit these really quick. So from the beginning, at the inception and the launch of Private Money Club, one of the things we're not going to be doing is we're never going to lend to individuals. So the individual might personally guarantee the loan, but we're not going to lend to them. So in other words, I'm going to pick on Aaron on here. Aaron comes to me and he wants to borrow money. And he says, and I say to him, okay, Aaron, what are you looking to borrow money for? And he says, my primary residence. Okay, is your primary residence going to be owned by a company or by you? He says, by me. Game over. I'm not going to lend to him. Okay, because I don't want to lend to individuals because it's just more difficult to foreclose against an individual because, well, there's rules. Dodd-Frank rules. The system doesn't want you to just be able to foreclose on someone because they didn't make their mortgage payment and they got young kids and you're going to throw them out on the street. No, they don't want you to do that. That's why banks, it takes so long to foreclose on a property, but eventually you'll prevail. But what we're going to do is instead of lending to individuals, what we're going to do is we're going to lend to entities. Okay, so that's the first rule. If you guys are taking notes, write that down. It's right in the book too that I gave you. But entities, we don't want individuals. We want to lend to entities. And can I make a suggestion? This is from personal experience. The other thing I would never do is, let's say you got a property and you got a tenant living in the property and they so want to buy the property and they want you to do a rent to own or an owner occ or something like that. Absolutely not, Stephen, right? That's a pitfall from day one. I've never had one go through. I've done them. So I'm speaking from experience here. I got that wisdom from failing. I've tried to sell properties to tenants on a rent to own or a lease to own. Not one. Mark, and I've been doing this a little while, not one has ever closed. So how about we just eliminate, never lend to an owner occ. Okay, so we're just going to lend to entities, LLCs, S Corp, C Corp, so on. Second thing, beware of unrealistic values. This is the biggest pitfall you're going to find. So this is one of the risks. Even on Private Money Club, I've seen this and I've stayed away from it, but some people will put up their idea of what their property is worth. They got this great property and they say that, the property is worth, here, let me share my screen real quick.
No, I was just saying, while you're pulling that up, one of the things as a lender that when I'm, hearing a pitch from a borrower, they're telling me about the deal or I'm reading it on Private Money Club, their description, something that, I see that's an immediate red flag is when they start saying like, well, we might replace a roof, or we're probably going to have to fix the kitchen, or we're probably going to have to knock these walls down, or the value of the house, after looking at the other ones is probably around $200,000 or whatever. Like whenever they start using these like maybes or ifs and things like that's an immediate red flag that they don't know either what they're talking about, they're not doing the proper due diligence, and it loses all confidence that I would have in them to do that they're going to be successful in the deal. So you want to be very, very particular and very strict as a borrower when you're putting that together. So that's something to look for when you're talking with a lender for the first time, especially.
This is all right in the book, folks, but let's just say we're just going to pick on this property. Okay, 123 Any Street, Buffalo. This is a real deal we did. We ended up wholesaling this, but that's not the important thing. Let's just say somebody sends you this, and this would be the start of a perfect loan proposal, and they say that the property is worth an ARV of 135,810. I don't know if you guys can see that on the bottom there. Right about here, 135. Okay, I can make this bigger if that makes it easier. So the person just says it, right? Are you going to take that as the gospel? It's a person that needs money. So the person with 123 Any Street comes to you. They need to borrow money. They're on Private Money Club. They post this deal. It looks great. It's complete. You're looking through it. You're like, wow, this is really nice. Whoops, let's not go there. Everything looks great. And they say, okay, it's worth 135. This is a problem. And this is where risk really gets elevated. If you just say, oh, okay, great, it's worth 135, and you do no more due diligence, shame on you. Like that would be like somebody saying, hey, I got this company. Do you want to invest in it? It's worth $10 million. I'm like, oh, cool, great. Yeah, I'll invest in it. Like, is it really worth 10 million, or are they just saying it's worth 10 million? Well, the only way to prove that would be software or having somebody that knows how to run comps, a BPO, which is a broker price opinion, or an appraisal. So they might give you comps here, which great. You can double check this, but in Private Money Club, one thing that's going to be given to every single person that signs up is going to be a underwriting software, because we're trying to make Private Money Club so simple and so easy for a lender or borrower to do business that, to look up comps and everything in the past, that's kind of difficult. You have to have some skill. You have to know what you're looking at. But what if you just put 123 Anytime, Buffalo, New York, into a software, and it just pulled up the comps? And it even told you this is a better suited rental, a better suited flip. It'll have different criteria. It'll have almost like a gauge, like a speedometer that will say this is a better flip than it is a rental, or this is a better rental than it is a flip. It's almost just like surface underwriting, but it gives you the ability to kind of justify, is 135 the right price for this property? Now, I mean, if any of you looked this real property up, I mean, 135 would have been a screaming deal. I bet you this house would sell for 250 today, but that's because we're in crazy times. So that's just one thing that you want to do. You want to make sure that when the values are put on there, that you're making sure that they're not unrealistic values. You want to double check the numbers. Okay, so that's another way to limit the amount of risk that you're taking. How about the DIY crowd? This is a big one. And I've experimented with this. Let's say someone comes to you and they're going to flip a house. And they bring this house to Private Money Club and it's on there and you're looking at it. Everything looks good. You've done all your due diligence, looks great. And you're reading the description or you're talking in the chat to this particular borrower and they say, oh, I'm going to do all the work myself. I'm a contractor. I'm going to do all the work myself. This should be a massive red flag. Now, in theory, that sounds like a good idea, right? Like, oh, they're going to do the work themselves. That means they're going to be able to make more money. But DIYers typically take twice as long to finish the property. So they might say, oh, I am only going to need your money for 6 months. If they're a DIYer, and this is, I'm not saying all of them are bad, but if they are, it's not going to take them 6 months. It's probably going to take them a year. Okay. And it's probably going to cost more money because their time is money. So, and they're going to get frustrated. There's a lot of things. So I always say, if you're a DIY, somebody else is going to be your lender. I'm not. I want experienced people that have crews that they've worked with that then will do the work. It just gets the job done quick. Because listen, I'm not looking to fund this thing for 3 years. Markets are changing. Things will change. I want to get in and out and I want my money back.
So Chris, on that, just to kind of expand on that just a little bit, so when we're looking at lending on a deal, first we are going to take a glance at, like for us, we use Private Money Club. If you guys want to become a member of that, excellent. If you don't, and you meet people at real estate investment association meetings locally, or people that do real estate, that's fine. But I always start, at least with me, Chris, is what are the basics of the deal? Let me just see, just the basic numbers make sense. Is it an area of the country that I want to invest in right now? Does the time frame fit what I'm looking for? And if those basics fit, then I immediately go and I look at the investor, the borrower, the person that's going to do it. So in your case, Chris, like the do-it-yourselfer, right? And so the way you find that out is, if they're in the Private Money Club, they complete something called a perfect loan proposal that tells you all about them, their experience, their company, their team. The team is the key right there with the do-it-yourself, because you're going to know, do they have a set of contractors that do the work for them? Do they have, what did you have when you were flipping houses, Chris? Like 7 different sets of contractors, right? So you had multiple teams all over, but that tells me that if one team disappears, you got another team that can replace them. So that gives me more confidence. So with a do-it-yourselfer, what if they're on the job, they break an arm, they can't do the work for 3 months? Then, their whole entire, proposal goes to shit, because now they're paying more to hire contractors. They could lose money. And so that's another reason why do-it-yourself might not be a good idea. But, going back to that, maybe they don't have a perfect loan proposal done. Well, in that case, fine. Let's hop on the phone with them and just have a 10-minute conversation. Hey, tell me about what other deals you've done. Tell me about, how you get the work done. Do you have teams? How long have you had those relationships with the contractors? Do you have a GC that you use? So these basic little questions, and this is all stuff we educate you on, like at the training in Buffalo coming up, more in-depth education than we might get to today. We educate you on in the Private Money Club to make sure you're doing it right. But I wanted to give some pointers today for people to go out there and start doing this, because it is an important way right now to be able to get your money out there working and making more money for you. So, start with that, find the deal, but then really dig into that person, because the person is arguably, in my opinion, more important than the deal itself. Like, I'll invest in a person before I'll even think of looking at a deal. You know what I mean? Odds are, if I like the investor, I'm going to give them money, even if the deal is iffy, right? Where if I don't like the investor and it's a solid deal, I might still not want to do it with them because I don't like the person. So the person is very, very important. So this is all about relationships, right? So if it's a new relationship, use the resources provided to you. Use that perfect loan proposal. Do a $20 background search on them if you don't know them. It's very inexpensive to do background checks on people these days. Ask for references and then hop on the phone with them and have that conversation. And I even recommend a Zoom. You can get a lot from somebody just from body language on a Zoom. That's why Zooms are so cool. So you can find out really who they are. So use the tools at your disposal and make sure that you have that part done right.
Oh man, that was some wise advice right there. The tools are all there for you folks. They've been there and we're just kind of uncovering them. But like what he said, lend to the person, build the relationship. I want you to all to think about like lending. A bank, when you walk into a bank to get a loan, you walk in because you have a relationship with that bank. Maybe you have a relationship with that manager. Maybe you have a relationship with that loan officer. There's a relationship there. This is no different, folks. I don't lend to people that are complete strangers. I get to know them. I build a relationship. Remember, I said my original vision for Private Money Club was Private Money Club was going to be just like eHarmony. It's a dating site. It's built off the same premise of a dating site. And when you're in a dating site, there's men and women, and then there's profiles, and then there's specifics about what they're looking for out of the other person. In most cases, you can get as involved. There's photos and everything else. And then in the middle, you say, hey, I'm interested. You start chatting. There's chat rooms. There, on the dating sites, there's actual chat rooms. Well, in Private Money Club, there will be a chat room. There is now, but it will be a virtual chat room, much like a Zoom. Heck, we might even plug Zoom into it. I haven't figured that piece out, but there will be a virtual chat. Because when you're on that Zoom, you can be talking to them just like this. So, tell me, how many deals have you done? And, if they can't look you in the eye or they're stuttering, like, okay, are they real? All right, well, great. You say you've done 7. Can you send me proof? Can you send me, copies of the recorded deal and everything else? There's proof on everything. So that's how it's going to be done. It's a relationship thing. And then, like a dating site, when 2 people come together and then they chat and they decide, hey, we're going to go out and we're going to do a date. Great. That first date is a test. Well, your first deal is a test. It's always a test, right? So if you do a first deal, maybe you jump in with somebody else and you lend, a fraction of the deal instead of going all in and taking it down. I mean, insurance companies do this every day. It's called reinsurance. Banks even do this. Banks sometimes will put up some of the money for a loan, and then another bank will put up some. It's, they'll come in and jointly do this. Well, we can do the same thing. Remember, we are the bank. We are acting and thinking and doing what banks do. So we have to act like that. I still get this on Private Money Club a lot. A lot of people will, I'll email about a deal, or they'll send me, hey, I've got this much, did you know any deals? They'll just send that over to us. And I say, yeah, have you looked at that one? Oh, I can't do that one. It's 155 and I only have 50 grand to lend. I said, you have 50 grand. I might have 50 grand. You think we can find another person with 55 grand? I think the odds are probably pretty good. And that's a real example. So you just got to expand your mindset to understand, to know that it's not about your actual resources. It's about how resourceful you can get. I keep saying that, man, that just fits in perfect. Thanks, Stephen. Stephen, I probably would have never used that phrase again, because I say things and I forget that I say them, but he always brings it to my attention that was one of the most memorable things that I said to him. So there you go. In taking deals down, maybe that's your first deal. You get to kind of do that first date. But maybe you like that first date. And then all of a sudden you get all the money back, and the date was successful. Then you want to do another date, don't you? And eventually, hell, you might even get married to that person. Notice I'm talking about a dating site, but now let's bring that to money. Same freaking thing. You lend to somebody, you have a great experience, you get all your money. You're like, man, the worst day in any private lender's life is when they get their money back because the income stops. That mailbox check that used to show up no longer shows up. That's the worst day. And then you're like, all right, well, I want to date again. I want to do another deal. You got another deal? I don't. So then you might have to find somebody else to date or somebody else to lend to, or maybe you wait for that person to come up with it because it's a relationship. But if you build several relationships, your capacity to move more and more money expands, and your capacity to diversify into different kinds of deals expands too. You might start with a single family house, a quick, wholesale deal like what Chris Naugle does a lot of. Maybe that's your first deal. You get the money back there. And then now I want to try something different. Instead of a blonde, maybe I want a brunette. I'm just joking here, but the same deal. Maybe you want to do, instead of a single family flip, maybe now you want to do a multifamily. So you land on a multifamily and you get your money back. Might have taken a little longer. And you're like, all right, cool. Well, maybe I'll try a redhead, and then you go and you do a syndication deal, and there's going to be some of those, or a note or something. You get what I'm saying? My mind works weird. You guys don't need to think this guy's crazy. He's talking about dating, but really it is. Private Money Club is the dating site for money. Rookies. All right. This, you could take this for however you want, but how many of you would really feel comfortable lending to somebody for the first time? Now, everybody's got to start somewhere. And this is where I kind of feel bad sometimes because I started somewhere, and that person that lent me money the first time, I couldn't have got where I was if they didn't believe in me. But I also shy away from rookies. So this is up to you folks, but you better do a lot of due diligence. You better make sure that the collateral and the security is in place, and you better make sure that they personally guarantee it and have the ability to pay you for the deal, because rookies can be the worst enemy. If you're gonna have a failure in private lending, it's probably going to come from here. We're doing our best to provide tools in Private Money Club to make it so even a rookie can act like, somebody that's done several deals because they have the tools at their disposal. Let me just show you one of the tools that is very important. This is where it started. It's called a perfect loan proposal. This is in the book that we gave you. Okay. This single tool allows a rookie to think like a borrower that's done hundreds of deals, because what it's going to do is it's going to walk them through how you as the lender want to see their deal proposed. And it's all here. This is all the teachings and the learnings, but we've turned this into a whole process in Private Money Club. So in the beginning, when this book was written in 2018, we used to do this long form. We literally would do a 3-ring binder. We gave you a personal financial statement. And I know I'm going quick. There's nothing on here that's important. Okay. It's in the book that we gave you, but I just want to kind of show you what it looks like. This is all the stuff that you have all filled out through the bank called personal financial statement. Every one of you have done this. This is what it actually looked like. It was a 3-ring binder. I have a bunch of them and had all these things in them, from table of contents, credibility piece, like who are you? Why should I lend to you? What is the deal? Which is that spec sheet that I showed you. What are the comps and the comparables, the appraisal, if you've got it. Let me see that you're a legitimate entity. Like, are you an entity? I want to see it. Show me. Articles of incorporation, operating agreement if it's a partnership. The personal financial statement. There's not a bank out there, unless you're doing a cash value line of credit with the banking policies, but there's not a bank out there that will loan money without a personal financial statement. You all have done them. Supporting documents to make sure that whatever assets you say you have, you actually have. Let me see your statements. Pull the curtain back. Let me see this stuff. How many real estate deals have you done? Let me see your tax returns. I think it's a crazy world right now because people believe people just because they say they've done a lot of things. Wholesalers, let me use that as an example. A lot of wholesalers, when I go to these masterminds, the wholesalers will say, oh, our business is crushing it. We're killing it. We did $5 million last year. And then my mind, just because I've been in this game a while, like, I don't get excited about that. $5 million, great. What was your net? Oh, well, we brought in 5 million and I don't know. Well, Jeff, let me see your tax returns. Oh, well, you know why they don't want to show your tax returns? Because you know what that line at the bottom says? 30 grand. It's not what you make, folks. It's what you keep. You know that. Tax returns show a piece of that puzzle, but you know what really shows it? If it's an entity of profit and loss, a balance sheet, that's pretty good stuff. And credit reports never hurt either. I mean, so all these things are just things that you can check to make sure that you're dealing with someone you want to lend to.
Chris, just on rookies, just a little bit more too. So if you are talking with a rookie, or if you're a rookie on here looking to borrow, just a couple of things that I would recommend: expect to pay more. So if I'm going to, if I can get 12% interest from somebody like Chris Fruit or Jack Petrick or Rob Fuller that has, decades of experience, has done thousands of deals. Well, if you're brand new, what that means to me is that's a lot more risk, right? So if I'm going to take on more risk, I want to be rewarded to bring on that risk. So expect to pay more than what you're seeing other people paying for private money. Number 2, highlight what your prior experience is. So were you in construction for the last 10 years of your life? You got sick of working for the man and you're deciding to go out on your own. Well, that's fine. That tells me that just because you're new to flipping, you kind of know your way around a house and how to make things happen and what to expect. So maybe that's a positive, or maybe you're an appraiser before and you just understand what houses need or whatever the case might be. So what did you do prior? And then why are you now a real estate investor? Why are you flipping houses? Why are you getting into this business? Did you, get mentoring from a company that you paid $100,000 to? If so, that gives me confidence, because odds are you got educated, you know what you're doing, you're looking for the right things. Do you have coaches that are helping you along the way that you can call and ask questions with? So those are all things that, like, if I'm looking at a rookie, that I want to know about. So if you're a rookie, highlight the stuff that makes you a positive reason to lend to. And then, like you said, Chris, maybe even a credit report, because once you're rolling with this, I don't give a shit about credit. You could, because I know it's all about the deal. But when you're brand new, you don't have that track record. So what does your past history look like when it comes to credit and paying other people back and things like that? So,
and I'm reading some of the comments just while Stephen was talking. Chris Ash has got some great things. The DIYers, they're too busy working a regular job to do the renovation. So then their anticipation, their goal was, I'm going to work my 9 to 5. And then after, I'm going to go over there. And on weekends, I'm going to go over there. That goes for maybe a month and a half. And then they get tired. And then they get frustrated. And then their spouse or significant other starts getting on them. Then their kids said, Daddy, how come you're never home anymore? Just saying, like Chris is calling it out. Alan had some great questions too. And Francis, we had a great question. If I want to join and get trained as a Private Money Club member and get trained. So the training is simple. There's tons of training videos in Private Money Club. Let me just kind of quickly give you a glance here, kind of like how Elon Musk would do it. We're not going to break any glass today, but like if you were on here and you came in, I mean, the very first thing you're going to do, this is the main page. It's going to look a little different when we launch the new version, but this is the one that's working now and we're using. Lender looking to generate passive income. Are you a real estate investor looking for funding, or are you learning the ropes? So let's just say you want to just learn the ropes. So you can come in here and there's tons of training videos, tons and tons of training videos that you can have, and it's basically just doing this. Now, let me just log in. So we had a lot of people abusing the free options. So there's 0 free options. You either pay or you're not in Private Money Club. But when you go in Private Money Club and you want to learn, there's a ton of tools. So here's all the different tools. There's trainings, there's resources, all sorts of stuff right here. The file vault, video training library. I mean, we've got all sorts of videos, tons and tons and tons of videos, and more coming, all about how to do this. So when you're asking, like, how do we actually learn how to do this? You just come in here and you see this little guy here, private lending basics. All right, I'm new to this. Well, let me watch some private lending basics. And he goes through and gives you private lending basics. So there's all sorts of videos and stuff like that. Plus every Monday we do Money Club Monday, which is basically just going to go into private lending. It's going to go into the deals that we have. And then, there's the campfire. These are all the different trainings we do every single week you can watch. There's different services. So I bet you some of you on here would love to be a private lender, but let me just pick on, my mother just got out of the ICU, and God bless the surgeons and the doctors and the nurses, man, they work so hard, but because they work so hard, they make great money. Like a surgeon, the average surgeon makes $500 to $1 million. It's a lot of money, right? They could be lending, but you know what the problem is? That surgeon doesn't have any free time to do this. So in order for a surgeon to be a private lender, they just don't have the time to do it themselves and look at it. They're operating, saving people's lives, like my mom. So what they might have to do is come in and hire the concierge service, which is part of the Money Club. Okay. And it's going to evolve, and this is going to become more of a thing where maybe you're too busy to do this stuff yourself. And what you do is you pay us anywhere between $100 and $500, depending on your needs and goals. And then your concierge goes out there, finds deals that fit your profile, sends you summaries of the deals, does some of the underwriting to help you understand based on what it is you need. Now, we're not going to tell you whether it's a good deal or not a good deal, because that would violate some stuff, but the concierge can kind of get you the data, the information that you need to make a decision. You say, yeah, I want to do this. So the concierge can help you do all of that stuff. So all this stuff is being developed out, and the process and the tools for any of these, but all these videos, like all these different videos on here, there's even a 4-week masterclass, folks. Like you can go on, like for that person that says, I want to learn how to do this. Listen, you want a deep dive? It's right here, right here. 4-week masterclass. It doesn't take you 4 weeks, but we just call it a 4-week masterclass. This is literally start to finish. When you're done with this, if you're not pretty freaking fluent in banking and lending and all the different stuff, then you weren't paying attention. It's super duper good. So we've got all this stuff baked into Private Money Club. It's not just the community, it's everything that surrounds the community for the education and everything that somebody would want. And so that's how you would do it. And outside of that, we do this every week live. So there's really only so much things that you should be scared of, because if you cover all your bases, this is another thing you should be aware of, is lack of capital. Let's say you're working with a borrower and they give you the personal financial statement. You're looking at, they're borrowing $200,000. And let's just say the monthly payment on that 200 grand is going to be $1,000 to you every month. And you look at their income, okay, it's 25 grand, red flag. Okay. You look at their assets, they got $2,000 in their bank account, red flag. That means they can cover 2 months, and then they're not paying for any food, no groceries, their kitty's not getting litter. You get the drift, like red flag. So you want to look at these things. You want to make sure that they have capital and also skin in the game. I will not lend to somebody. That's a lie. I lend to Chris Ruud pretty much all of the money he needs, but you got to understand something. When you talk about a relationship, like I've got a solid relationship. I've lent to him. I can't even count how many times now. I was talking to him the other day. I said, hey, Chris, you got any more deals? We need more deals. People want your deals. And he says, dude, you got like $1.5 million of deals and you want more. I'm like, yeah, not me. People want deals. So, it's just like that person's got a lot of experience. So there's a trust level. So I might lend a little more, but typically I will limit the amount that I will lend, because I will not over leverage the loan. I'm usually going to be 65 to 70% ARV, because I want that borrower to have some of their own money in the game, because now they're committed. Like if they got no money and something goes bad, They bail, like, whatever, come after me, take the property, I don't care. I didn't have any money in it. But if they've got, 30% or 40 or 35% of their own money in, damn, they're finishing that deal. So these are just things to be aware of. And also this is another one that you got to be careful of. We don't really see this because we do monitor some of the stuff. We're not checking your deals. We're not doing due diligence in Private Money Club. It's an open community. Listen, a dating site. Do you think eHarmony's going through looking at every one of their members' profile saying, oh, this is not a good person. This is a crazy person. We can't let them be on there. Well, we're not going through all the lenders and borrowers saying, hey, this person's a good lender or this person's a good borrower. That's for you to figure out. It's the beauty of an open community. We don't get in the middle. So, when you're ready to go on a date, we're not going to be like, whoa, hold on a second. Player number one, you ready? Player number two, you ready? All right, let's go. We're not doing that. Like, you just go do your thing. Like, it's open architecture in the way that it's designed. So these are just things to be aware of. Now, folks, again, I'm going to put the book up. All this is in the book. I know I wrote the book in 2018, but these fundamentals are very simple. Remember I said earlier, the Bob Dylan quote, the times are changing. They sure are. So how many of you are real estate investors and you know this terminology? Not to be confused with Mr. Burr, but buy, rehab, rent, refinance. And then I used to add an R for repeat. How many of you know this? Okay. That's right. George said yes, like it's a great strategy. But let me tell you something. It was a great strategy. Keyword, Burr was a great strategy. Now, it still might be a good strategy today, but you know what? In a few months or maybe a year from now, this isn't going to be a good strategy. Do you know why? Because this strategy relies on somebody buying a property. Let's say they use private lender, so private money at 12%. When they bought the property, they had several exit strategies on this property. Number one, main one, I'm going to sell it. Exit strategy number two, I'm going to refinance it. That would be the Burr. Okay. So they might have a couple exit strategies. And number three, they're just going to rent it. So first off, let's just say the market keeps doing what it's doing. Let's say the Fed next week, I think it's next week, jumps rates a full percentage point. Now, does everybody know where the 30's at? Steven, do you know where the 30-year fixed is? Is it above 7 yet, or are we just under 7?
I actually don't know.
All right. So somebody on here might know where the 30-year fixed is. I haven't looked. I mean, they're going up so fast, it's hard to keep track of. But let's just say they're 6. Next week, they might go to 7.5. And then a month after that, it might be 10. At what point does this all of a sudden not make sense? And at what point do people not have the money to afford the property here? So that's a risk, right? That's a real serious risk. Second thing, they go to the bank to refinance it, but now the bank is 10%. Okay. Now all of a sudden it might not make sense to refi with the bank. And hell, maybe the bank all of a sudden isn't even lending because they're froze up because the Fed sucked all the money back out of the markets. These are just, I'm just playing devil's advocate here. And then the last one is rent. If they rent it, can they afford you at 12%? So here's the thing. If the Burr strategy is, to me right now, a little bit on the riskier side, before I thought it was a very great strategy. I did lots of them, but in this new environment, I think it's kind of a bit scary. So the one thing I'm going to try to do in Private Money Club, there's not, there's two types of people out there, folks. People with money that want to make money. Many of you on here are people that want to make money. And then there's people that need money to make money. And that's the borrowers. There's also borrowers on here, right now. So if we bring those two people together, what we have to understand is not all those people are the same. There are people that have money that right now would be fine making 7% fixed because their money's sitting in a bank account and they're making 1%. Okay, so they might be fine making 7. Money might be sitting in an infinite banking policy, so they're already making money once. And they're like, okay, well, I'll do a long-term deal. I don't want to keep doing these quick turnover deals like Rude's every 6 months. It's too much work for me. I want long-term. So I'll lend on this deal. The rent supports this. I'm good making 7% because I'm making a spread. Let's just say they're making a spread of 3% because they're 5 years or so into it. Plus they're making 7. So now they're doing good. They're making 10%. And I know we're in a weird time, folks, with inflation at 9.1. And I know we talk about it a lot, but we talk about it a lot for one reason only. It's on your mind. It's in the news. Okay. I'll be the first to tell you what we're dealing with this year with inflation isn't going to be an issue next year. We probably won't have as bad of an inflation problem. This is a temporary problem. So when you're looking at all this, we get this all the time. Does the whole life policy keep up with inflation? No. But you know what does? Following the infinite banking concept, the process will always beat it. When you move your money, like the policy might only be 6%. So if inflation is 9.1 and your policy is only making 6, are you beating inflation? No. But that isn't what we teach. The policy is just the machine. What do we do with the machine? We run money into it. And what happens? We move money out of it. Once you understand that the process is where you make money, the process is where you beat inflation, and the process is what makes you wealthy, not the dumb policy. The policy just lets our money move through it, and we make a spread in doing that. So when you move the money out, maybe a 7% long-term deal fits that person's criteria for risk versus reward. So then there might be somebody on there that doesn't fit. Maybe the person this guy or gal borrowed private money from at 12%, got himself in a pickle because he couldn't sell it, couldn't refinance. So now he's got to rent it. But if he rents it, he's upside down at 12%. Well, maybe this guy here or girl that owns this property needs to go back to Private Money Club, find another lender that will take the deal at 7, because that's the number he figured makes sense, and then refinance out the first person. You see, that's how the borrower should be doing it. And any experienced borrower should do that. I hope that makes sense. But I really wanted to hit on this because the things that worked last year might not be the things that work this year. You have to be very careful. What your risk tolerances are this year might be different than next year. You know, and the BRRRR strategy is one that I think in the near future is going to be on the chopping block, or at least just a little bit more difficult because of rising rates, banks not wanting to lend as much, and people getting into houses for a little bit more money than they want. Listen, I'm in one right now, 65 Headley Place. We put it on the market. It's spectacular. You saw me do a Facebook Live on it. I'm in a little bit of trouble with that. We had to hold that thing straight through COVID. We had squatters. It's been a nightmare. It's been an awful property. We finished it, but now it's on the market. And guess what? 6 months ago or 5 months ago, that price that it's at today would have been a decent price. Probably would have sold immediately. But today we're getting no showings. So my opportunity is what? What do? I BRRRR it. First thing that comes to mind, take it to the bank, refinance it. Well, if I look at the comps, the highest is 240. So if I get 240 and then I get 80% from the bank, I'm down around 180. I owe investors 201. I'm a bit upside down. Now for me, I have the capital to put in, but if that was somebody that didn't have the capital, now you got yourself a problem. So you see what I'm saying? So these are the things you need to look at. The strategy that you're going to lend on should be appropriate for your risk.
So we talked about, kind of taking a look at the deal and what that looks like, taking a look at the investor and what that looks like, things to avoid. What about, the logistics of it? So I identify an investor, I identify a property, I want to lend to them. You mentioned lending to a company, not to an individual, but what does that look like? Like, do I send them a check? Do I wire the money? Is there, what do the contracts look like? Is there a mortgage? What's that look like? I said we talked about that.
So folks, this is chapter 7, execution. You found the property, you analyzed the deal, you chose what strategy is best for you or the end buyer, you structured the deal. Structuring the deal would be the note, the mortgage, and that's what I'm going to get into now. You finance the property, maybe even the rehab portion, you renovated and managed. This is kind of walking through that whole process, okay? So let's come down here. Step 1. This is how Private Money Club is going to work. Step 1. Okay, you can't go to step 2 until you complete step 1. Step 1 is going to be, okay, what kind of a deal are you doing? Is it going to be just a standard lending deal, just you and one other person? Is it going to be a partnership, like a joint venture deal? Is it going to be a syndicate? There's going to be a menu of options that you can pick from, which we'll keep expanding as we go. Then when you click which one, it's going to take you to step 2 and step 3 and step 4 and so on and so forth to walk you through the deal. But eventually, kind of what Steven's talking about, I'm just doing this to give you a visual here. So folks, I know some of you are trying to read this. You already have a copy of this, okay? These are different things that you're gonna have to look for, preliminary title and all that, but I just wanna get to the visual so that you can then see the flow. Here we go. All right, so the first thing you're going to do when you both, talk, you communicate, you decide that you're gonna do the deal, the very first thing that's gonna have to be put together are the terms, the agreements. The first thing we're gonna do is we have to come up with the terms for the type of deal. Now, let's just assume, for keeping it simple, we're just going to do a traditional, you're going to fund a flip or you're going to fund a deal. Okay. It's just you lending to that borrower's entity. The terms are going to be set forth in the form of a note. Commonly, you've heard of these, a promissory note. Okay. A promissory note, and please don't make this mistake, is not a security instrument. It is simply the terms of the agreement. It is like you and me saying, I owe you this and you are going to lend me that. That's it. So it would say, okay, XYZ 123 property. You got the address. I'm going to lend 100,000 for 12 months. And there's a little bit more detail. You know, there's usually multiple pages in these. But anyway, 12 months at a rate of 12%. Monthly payment is going to be $1,000 a month. And if you don't pay me back by the 18th month, you're going to give me the deed. And if you're late, blah, 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 here's where you mail payments, all the specifics, the legal mumbo jumbo. You should not write your own note. I didn't. Your note certainly should be done by an attorney. Now, what kind of an attorney? I suggest a real estate attorney. Not all attorneys are the same. Do you know that? Did you hire a real estate attorney to handle your divorce? No. Did you hire your divorce attorney to handle your litigation? Nope. You hire an attorney that's a specialist in the thing they do. Just like all of you that work with us for the privatized banking and the infinite banking concept, you work with us because we are specialists in that. That is what we do. That's what we're the best at. So you're going to find somebody that's the best. Now in Private Money Club, it's not there yet, but eventually we're going to have a menu of attorneys that you can work with, specialists in this field, and we'll vet them out. And not only that, you might not want an attorney. You're like, I don't want to pay an attorney because, hey, what would an attorney charge to do a note? I don't know. Let's just say we negotiate a flat rate of $500. Maybe you want the attorney to do that, but maybe you're like, no, this note thing's way too easy. Can't I just get a form? Isn't there like a principal form I can use? Well, we're hoping, let's say like a legal Zoom of sorts, where you basically can just go in and we will have several sample notes, option 1, option 2, option 3. You pick the one and then you just fill the stuff in. And maybe LegalZoom charges you $20. I don't know. I'm just making this up. This is what Private Money Club is going to have in the future. And then you do that. So that's your first step, right? The terms of the agreement. Now, who signs the terms of the agreement? Well, if it's an agreement that I'm the lender and I'm going to lend, who can I pick on? Dylan. Dylan's right there. And he's got a critical question that we will get to. All right. So I'm going to lend Dylan money. So we do the note. These are the terms for Dylan's deal. Who is going to be the one that's going to sign on the dotted line? Is it me, the lender? Nope. Is it Dylan, the borrower? Yep. Because Dylan is agreeing to these terms. I'm simply saying I'm going to give $100,000 lending to this property with X amount of security and blah, blah, blah. And Dylan signs off on this. Okay. Now that's done. So what's next? Once the note is signed, okay, that means now the lender, me, I could then send the money to escrow. So now let me give you a visual. So now we're here. We did the note right here. Okay. Finally, the note and mortgage deed of trust is recorded, blah, blah, blah. I didn't get to the mortgage yet, but I will. So right now, I then send $100,000 to a third party escrow. Key, write this down. Never send the money to the borrower. So I'm not sending 100 grand to Dylan. I don't care how great Dylan is. I don't care how much money he's got. I don't care, anything about Dylan. He's not getting the money until the deal closes. So the money goes to an escrow account. Escrow can be a title company. Here in New York, we use attorneys. So I send the 100 grand to escrow. So now my 100 grand is sitting in an escrow account waiting for this deal to close. While the money gets to escrow, what I'm going to expect Dylan to do is I'm going to expect him to go find a good P&C agent. He's probably already got one. And Dylan's going to get an insurance policy insuring that house or that asset for the amount that I'm lending, at least the amount that I'm lending. He's probably going to do more, so that if it gets struck by lightning, something happens, I'm the first one getting paid. Okay, so on that security or on that insurance policy, I need to be named as additionally insured. So if that house burns down because Dylan, miswires something and it fries overnight, I'm the one getting the check, at least up to my $100,000. And you can actually negotiate and say, hey, I want $100,000 plus I want my interest, so on and so forth. So once the insurance policy is in force, Dylan then would send it to me and probably give it to the attorney or title company as well, because that will be required. After that's done, the closing documents are going to be finalized. So the closing documents are going to be a deed of trust or a mortgage. So that now you're talking about the security instrument. Now, again, you're not going to be the one doing this. The title company or the attorney is going to be the one putting the mortgage. Every single state, actually, I think every county, but we'll just do every state for now, but it's probably every county has a different standardized mortgage or deed of trust. So you're going to do the deed of trust or a mortgage, and that's going to be filled out. Again, I don't sign that. Dylan does. Dylan's the one going on the hook. Dylan's the one collateralizing it and saying, hey, if I don't pay, Chris is going to be able to take this property after X amount of time because the note said that. So now once Dylan signs that, so we've got the note signed. Now we got the insurance policy in place, naming me, the lender, additionally insured to whatever amount I want or amount I'm lending. Okay. The closing documents are prepared by the title company or attorney, which is going to be the mortgage, the security instrument and everything else. Right here, we got the mortgage deed, sorry. And then the deal closes, but see, here's the part. A mortgage means nothing if it's not recorded. So the attorney or title company is going to get it recorded at the courthouse where the deal closes. And then you're going to get a packet sent over by the title company or the attorney. As the lender, I'm going to get recorded paperwork showing everything's filed. You are secured. Folks, I've had scares where I've lent money and then all of a sudden I forgot that I did the security because we were doing so many deals. And then all of a sudden something happens and all of a sudden I'm calling the attorney, hey, I just want to make sure, are you 100% sure that mortgage is recorded? The attorney, within usually minutes, if they're on top of it, sends over the recorded copy. Whew, I feel good. Now I know. And at that point, now the lender receives the documents. And once that's all done, the money then goes over to Dylan. Dylan closes and so on and so forth. So those would be like some of the flow charts on how this works and some of the things you can do. Note, and then the money goes to escrow. Sorry, I was drawing it, but you kind of saw escrow. And then we're going to get an insurance certificate here. And then we're going to get the mortgage or deed of trust. And then after that, all is good. The only thing that might be, if you're lending on the rehab, there might also be a draw schedule that you come up with. All right, Dylan, I'm going to give you draw number 1 of $20,000 of a $40,000 draw to get started. Draw number 2, when you can show me with an inspector going out and proving this, that everything's done, I'm going to give you another 10, and then I'm going to give you another 10, and that's 40 grand for rehab. But all these come with an inspection.
He was just given some really good advice. He said one crucial question he learned to ask when doing his first private lending deal is, when does my interest start accruing? I had assumed it was always the day the funds were received by the borrower, but that's not always the case. So that's something that would be defined in that note that you were talking about with those terms. It'll say when those, interest payments start and what that looks like, the schedule of them.
Correct. And, and it's always going to be different, but typically, just so you all can kind of get a little bit of clarity on that, most deals will not start paying interest until the deal is closed. Because before there's ownership of the property, the funds technically aren't live. I mean, they're sitting in an escrow account. Now, some lenders don't like putting the money in the escrow account because then that money's not earning interest. For example, like let's say you're lending from your privatized banking policy, your specially designed and engineered whole life. You're lending from there. The second you take the loan from there, you're paying interest to the insurance company, but that money might not be working. So you'd want to time it so that it's like a week out. And that can be tricky, but that's it. Or you can negotiate, like with Dylan, I could go to Dylan and say, hey, Dylan, the second the money hits escrow, that's when the interest clock starts, ticking. So again, you're in control of this. Every deal I do, I don't start receiving interest until the deal closes. Because if I'm on the other side of it, and I've been on both sides, I've been a lender and a borrower. If I'm the borrower, I don't want to start paying interest on money on a property that has not closed. If it was push come to shove, I probably would. But again, that's probably not the best way to do it. So just negotiate that, but it's definitely important. So another thing too that I wanted to hit here real quick, and me and Steven can kind of, do this one together, is sources of funds. When you're going to be a private lender, I mean, your money's got to come from somewhere. So if we were to just identify sources of funds, so you might have savings or checking, right? Maybe this is where you're going to lend from. This is kind of just lazy, useless money. So this would be number 1. Or let's just say you got yourself a 401k. If you got a 401k, maybe you could take a loan for $50,000. A lot of people on here have listened, to kind of what we've said, and they've gone and extracted that lazy money off their couch and they got a HELOC so that the money that is equity in their house is now available to them to lend. So a HELOC is good. Now, if it's a 401k, a HELOC, or let me do the fourth one, which would be your IBC policy. Remember, all of these are going to come at a cost. So your 401k might charge you 5%. I know the money's going back in your 401k, but you still got this headwind that you got to get over. So if you're going to charge 10, you're going to net 5. Technically 10 because you're keeping that. But a HELOC, let's just say it's 5% interest. So if you lend that money out at 10, you're making a 5% spread. Not terrible. IBC is the best of them all because, let's just say your loan interest rate to borrow is 4 to 5, depending on the generation of your policy. Your money never actually leaves your account. So, if you were lending 100 grand, it was in here, that money is going to be earning between 5 and 6% by today's standards. And if you're getting charged 4 or 5, you're making a spread because your money doesn't leave the account. So this is the ultimate place to lend from because you get to make money twice because of the way that the infinite banking, the way that the policies work and the way that the infinite banking concept works. So, and then another one, this is also something I do a lot of, is self-directed IRAs or solo Ks or, a self-directed Roth IRA. Great place to lend from because this money is all tax-free if it's a Roth or tax deferred. So this can be one of the most effective from a tax standpoint, but you're going to get whacked on the back on the, someday later if it's not a Roth. So these are just a few of the sources of funds, but just know that each place where your money is, and you might lend from various sources. Like I lend a lot from my IBC. I lend from my self-directed IRAs. And in the past, I have lent from my HELOC. And when I had a 401k, those days are long gone, but I've lent from those different ones. I typically don't keep much money in a bank account. I hate traditional banks, so therefore I don't let them hold much of my money because I don't want them making my money work for them. I'd prefer to make it work for me. So these are great places to lend from. Again, the ultimate would be your infinite banking policy that's specially designed whole life and the self-directed IRAs.
The only other source that I would say when you're looking at you're talking about retirement accounts, if you're on the borrower side, would be just to be able to educate people that they can use retirement accounts to do these kinds of private money loans. Because a lot of people don't understand that, a lot of people understand money sitting in a savings account or, once they learn about IBC, they know they have access to that. So things like HELOCs and things like self-directed accounts are things you can educate people on that they might be like, wow, well, that solves a lot of my problems because my retirement account's losing so much money right now. Well, hey, I can lend it to you and make a solid 12% return. So if you're on the borrower side, it's just something to really learn about and use it to your advantage if you're doing it, without the help of something like Private Money Club. George was asking, which is preferable, self-directed IRA or infinite banking policy? And the answer to that is yes, or both. I mean, because the reason I say that is they're both going to be the preferred ways to do private money lending. Because why? Well, those are the only two ways that you're taking advantage of tax laws. So they're two separate things, right? So you can draw a line in the middle of those two things. So infinite banking is all of your non-qualified money, according to the IRS. So non-qualified meaning money that's not in a qualified retirement account, like an IRA, a solo K, a 401k, a SEP, a simple, et cetera, HSA, et cetera, right? And then, so that'll be IBC. The self-directed side is all the qualified funds. So those things are completely separate. But the reason why I say, yes, those are two of the best, those are two of the most preferred methods for lending from is you're getting advantages to them. So with an IRA, you're either getting tax deferred or tax-free growth on that money that you're lending out. With the IBC, you're getting the uninterrupted compounding tax-free growth within the policy while you're simultaneously lending the money out. So you're taking advantage of tax laws over here also. So as opposed to, and I can show you a quick example, Chris, if we have a second here, but the advantage of lending from an IBC, your own bank, as opposed to lending from a savings account at Wells Fargo and what the difference in that looks like. And it's staggering when you look at the difference. So if I'm going to do private money lending anyways, why not take full advantage of everything that the IRS and the government gives me access to?
The only reason I think people should have a self-directed IRA, I guess, unless maybe a Roth would be the outlier, but the only reason you should have a self-directed IRA is because you already had money in an old 401k, an old retirement account, and you just wanted to take control of it. Otherwise, a lot of people ask us, well, where should we start? Should we put money in IBC first, or should we fund our IRA? It's almost always IBC. Maybe you could, if you were a wholesaler or something, maybe we could make an argument that the first thing you should do is set up a Roth and fund it, to the max, 6,000 or 65 or wherever. But you gotta know that, I'm always going to lean toward IBC. It's more flexible.
Can you see that, Chris?
Oh, yeah.
Hmm? All right. So just to give you a quick example, right? So I do this in my presentation usually. So this was a policy we designed. This is what we call these. If you're brand new to this, join us on Tuesday night or go to chrisnaugle.com or the YouTube channel. You can watch the full 90-minute presentation or send me an email and I'll send it to you. But this is what's called an illustration. So this is the money multiplier policy right here, kind of like under the hood of it. So what we see is this was a 41-year-old lady that we did a policy for earlier this year. She was, so you can see she put $150,000 in the first year and then $50,000 a year after that. So, you've got to put money somewhere, right? So here's the difference. My option, if I have 150 grand right now, I can stick it under my mattress. I can put it in a savings account at Wells Fargo, or I can put it in my own bank with the money multiplier whole life policy, right? So we got to put our money somewhere anyway. So let me just give you an example here. Let's just skip forward to the 8th year of this policy, okay? In the 8th year of this policy, my bank grew by $66,000. To get that growth at my bank, in my bank account, I had to inject $48,000 into that policy that year in the 8th year. You can see that right there. I put $48,000 in, my policy grew by $66,000. So that is an $18,000 growth or 37% cash on cash return on my money that year. Now, I didn't do any work to do that. I didn't take on any risk. I didn't change anything I was already doing except where I'm depositing my savings to anyways. So in this case, I'm depositing it into my account to get that 37% growth on my money that year. That's it. I'm not taking on any risk. I'm not doing anything here, just putting my money somewhere else. Now, what does Wells Fargo pay me in that same exact example? Wells Fargo pays me right now on 50 grand about 0.2%. Okay. So would I rather get 0.2% or 37%? But then let's take it a step further. So let's say I'm going to do a $100,000 private money loan at 12%, right? Well, if I was to do a 12% loan for my Wells Fargo account, I take that 100 grand from my Wells Fargo savings account, I lend it to the lender, I make 12%. Well, in this case, I'm taking the money from my bank account, okay, from my money multiplier policy, and I'm doing the same loan. But here's the difference. I lend that money out at 12%. I'm paying 5% in this Lafayette-like policy to use that money. But my money within my policy grew at 37%. Now, this is tax-free. I'm not even talking about taxes here. But at the end of the day, what I was able to do is with that same 12% private money loan, I was able to generate a 44% return on my money that year. So let me ask you guys that question. We did nothing different except where our money goes first. Would you rather make 12% or 44% on your money?
When we're talking about which one should you start with, I mean, the infinite banking concept, and I'm just calling it because that's what but the whole life policy is definitely the starting place. You're not going to get any of that in these sides. You're just not. It can't exist that way. The Roth is great, because the only thing the Roth gives you, IBC doesn't, is all those gains he was making on that private lending deal. If it was a Roth, they were going to come back in here, even though he doesn't have access till technically 59.5. He doesn't have to pay tax on that money. So that's the only real advantage. But Roths are severely crippled because you can only put $6 grand a year away. It's going to take most of us on here a very long time to get a Roth IRA to a level that's really going to make a dent in our financial future, unless you started really young. If you got a kid, set up a Roth for your kid. But
yeah, and right now, the backdoor Roth conversions are still legal, so that might change. But right now we can still do those. So if you do have an old 401k, depending on your age, how much money, what your overall financial strategy looks like. And this is all stuff we can talk about on a call. So if anyone wants to talk about old 401ks and is self-directing a good idea, then let's hop on a call and discuss it. But one of the things you can do is, let's say you have, $300,000 in an old 401k. Well, you can move that over to a self-directed IRA. You're not going to pay any penalties or any taxes or anything for moving it over, but there might be a situation where it's smart to go ahead and convert that when you switch it over to a self-directed into a Roth. Now, you will pay some taxes on that money, but we're getting those taxes out of the way now. And I think we can all agree that taxes are going to go up. I was just looking, there's a reconciliation bill that's starting to get some support in the Senate. And the Small Business Administration just wrote a letter to Congress this morning. So this is just breaking news coming out right now, basically urging them, do not pass this bill because it's placing large tax increases, almost primarily 100% on small business owners. And after small business owners, everything they've gone through the last 2 years with COVID and being shut down and struggling to keep afloat in the first place, and with the economy doing what it's doing, small business is already in a tough position. So just throwing a bunch of new big tax taxes on top of them just to pay for all this bullshit spending and everything happening right now is crazy. So that's a whole different situation. But the bottom line is why not pay those taxes today, get it out of the way, get that money in a Roth account where all the gains you have for the rest of your life until you pull the money out is all tax-free growth. So to me, that makes sense to possibly do that right now. Not always, but it could make sense.
It makes total sense. And the other thing too, I would say is, what Christine said, and I'm just putting this up here. So your money is earning interest while you borrow their money. Correct. Your money is earning uninterrupted compound interest because it never leaves the account. If you put 100 grand into the IBC, and let's just say, I don't know, let's just use 5 to 6% because, there's different interest rates and dividends with different carriers. If it's earning 100, if you got 100 grand earning 5 to 6, but then let's just say I take 100 grand out to lend on Private Money Club, it doesn't matter. Your 100 grand never left your account. The 100,000 you lent was actually your death benefit being advanced to you from the insurance company, which is why they charge you interest. So they charge right now, most of the carriers are 4%. So they're going to charge you 4%, but you're earning money on the full amount. And there's this big discussion going on one of the Facebook groups. And if you aren't part of the IBC Facebook group, it's the IBC one. It's like kind of got a black background. Get part of that. There's a big discussion going on there because a lot of people think they understand math and they think they understand mathematics, but the thing they don't understand, they might be able to do simple math, like 6 minus 4 is 2. But then they say, well, wait a second. If my money's earning, we'll use an old policy, okay? Let's say my money's earning 5. I'm just trying to keep this simple. My money's earning 5 and I'm paying 5. What do most of you think you're making? Most of you think you're making 0. But this whole argument on IBC group is you're actually making more here because this money's compounding. This is simple interest. So every year, instead of 10,000 one year, next year you got 10,000 or 105,000. And the next year you got more and more and more because of compounding. So you're always going to beat simple interest with compound interest. But this is the only vehicle on earth that I'm aware of that allows you to do this. Sure, you can leverage your stock portfolio with a margin account and get check writing privileges, but you got to have a big account. And I don't mean to hit this one, below the belt, but how's your stock portfolio looking right now? Enough on that. I don't mean to keep hitting that. So those are the different things that you really should be looking at. I mean, where your money starts might not be where your money ends once you start learning about this. And I know there's a lot of people on here for the first time, so hopefully you pick some things up. One other thing too is, listen, it's one thing to join us for these. We do these every week, but we've got a live event at the end of this month. Like, we haven't done any live events here, but we are doing one 16 days away, 16 days. Time to get some of those flights out here. If you want to fly out here, if you're in Florida, I hate Frontier, but Frontier's got a direct flight, and my friend just got tickets for $44, okay, from Florida. But there's cheap flights here all over the place. You come in and, for some of you, if you want to join us for the VIP, it's going to get you lunch. It's going to get you a bonus night. So you'd come in on the 29th, make sure you're here by 6 o'clock. And we're going to basically take a limo downtown Buffalo. We're going to go to a ball game. Okay. We're going to be in a suite, a 50s themed diner suite. And then we're going to basically have fun. And then there's going to be a fireworks show. We're going to limo back. And then the next day it kicks off. So you can see we got private club level suite, elite private networking opportunities because you're going to get one-on-one time. We got some new speakers that just confirmed last minute that are really big names. I'm not going to release them. You're just going to have to see who they are. But one of them is
it's a speaker hall of fame. He's a top 10
Hall of Fame,
world-renowned speaker in the world.
So he's incredible. And
he speaks for presidents, dignitaries, the military. They fly him all over to speak in front of the military and encourage the troops. Just an unbelievable guy. So he's I can't wait to hang out with him for the weekend. He's a lot of fun too.
For sure. And then you just go to your checkout, you sign out, you pick which one. And also we do have a virtual. So some of you are like, oh, I can't get to Buffalo. I guess I can't do it. No, there's a virtual option. It's going to be a whole thing because Steven's going to be running the virtual option from here. And I'll be running the live event from there. And I just noticed there is a flash sale. I thought we sold out of those. We had some like extra seats. They're not very good seats, but they're extras, might be standing. They're $197 instead of the normal $297. So I don't think there's many of those left. But if you grab them today, you can save yourself $100 on the tickets. You might not have prime seating, but it's all stadium seating in the event because we rented out a movie or a TV show studio. So that would be what you'd want to do. And then just complete your order. And then we can see you out here and have some fun and teach you a heck of a lot more. And not just me teaching or Steven teaching. It's going to be some of the best speakers from around the country that do this stuff day in and day out, the experts in the field. So that's going on. And two other quick announcements, because I know we're wrapping, you got 2 minutes left here. One other thing too, at the July event, the 29th, the 30th, and the 31st, I'm going to be announcing something that I only have 4 seats for. Okay, it's going to be a very private, very intense training that is incredibly specific on each of the 4 people that come. So we've been talking about this for a while. It's called the program. Okay, there's only 4 seats. And do you know why there's 4 seats? Because I have room for 4 people in my bar lounge at my house, because that's where part of the event's going to be. So we're going to spend one whole day at my house. Okay, and I also don't want a lot of people at my house. And we're going to basically really deep dive there. Second day is going to be right here in this studio here in this office. You're going to get to meet Cash. If you like cats, we'll leave him home. But you're going to get to come here and we're going to create a whole bunch of unbelievable stuff. We're going to put our marketing team and our resources behind you and your company. And we're going to create a whole bunch of stuff that you see us put up on YouTube. We're going to do it for you. We're going to produce your videos. Okay, we're going to help write your scripts. We're even going to have you on 2 different podcasts while you're here. Okay. The cost for this event is going to be $7,500. It's not cheap, but the $7,500 includes this: the 2 days with me, all your food, all the drink you can drink, cigars. It's going to include shuttle service. I don't know if I'm going to do a limo yet, but shuttle service, probably like a black Uber from whatever hotel you stay at to my house and back. Okay. And it's also going to include your flights. So we're going to fly you here and fly you home. So it's all going to be done through our travel agency. So you literally don't need to think. People don't want to think. Okay. But that's it. There's only 4 seats, $7,500. And the only people I'm going to offer those 4 seats to, I know I'm telling you about it and you're like, oh my God, I want this. Maybe you are, maybe you're like, that's crazy. I'm not spending $7,500. To each their own. You would spend $100,000 if you knew what you're going to get out of this, but it's $7,500. And I'm only offering this to people that show up to the event. You don't have to show up. You can be virtually, but it'll be virtual or live people that come to the Buffalo event. Only 4 of them are going to have opportunity to do this. And I don't know if I'll do it again. We'll see how it goes. It's the first time I'm doing it. It was my brainchild. It's something I really wanted to do, a really, really intimate deep dive into people's, needs, goals, and then giving them access to the resources that I have that's taken me better part of a decade to build. And they're going to be yours for a complete day. And our focus will be on only those 4 people and creating their content. So that's what we're doing. Those will be the things. And then also, I don't know how many seats are, Stephen, how many seats do we have left for the experience out in, I
believe there's 12.
12. So we're not really talking about it now, but you'll hear it after the July event, our launch for Private Money Club. If any of you have ever heard rumors of Steve Jobs launching, the iPhone, or Steve Jobs launching the Mac, which was the epic one, or Elon Musk doing the Cybertruck, or Elon Musk doing one of his cars, like that was a whole production. That's what this is going to be. The launch of Private Money Club is a whole production, literally between marketing and forget about the development of the software, but just marketing, setting up the room, the stage, and everything. Well into the hundreds of thousands of dollars we're spending to make this like an epic, once in a lifetime experience. And there's 12 seats left. They're $5,000 each. Again, includes food, booze, all that good stuff like last time, and helicopter rides and fly fishing. But really, you're going there to witness something that is going to be of epic proportions, something that will be remembered for the rest of your life. And that will be the launch of a software and an idea that will change the way money works for the rest of all of our lives. And that, you might be thinking, oh, Chris, you're a big dreamer. Well, you know what? If you dream it, you believe it, you will achieve it. And I will achieve this, and it will happen. So those are the different things I got for you. Okay, so join us in July virtually if you can't make it out here, or get the last of the tickets that are available. Try to join us for the VIP. And we're really looking forward to seeing you. And then for those of you that want more today, well, that's easy. Ask Me Anything is in a few short hours. We'll be having a cocktail, answering your questions, and having some fun. And we stream on all channels for that, from YouTube to Facebook. So make sure if you don't know how to get on the Ask Me Anything, make sure you go to my YouTube channel at the Chris Naugle and subscribe to that, because that's how you're going to know about it. Anything else you want to put in there?
No, I love it, man. I'm looking forward to everything we got coming up right now.
It's an exciting year here. It's an exciting year at exactly the right time because things are changing and you need to change too. So folks, thanks for joining us for another episode of the Wealth Webinar. We'll see you soon. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.